Welcome. Today, I will dive deep into the world of startup financing. If you've dabbled in the world of startups and venture capital, you've probably heard terms like Series Seed, Series A, etc. But what exactly and why is it called a Series A round? Or pick your letter. But what is it exactly? And why is it called a Series A round and not just a funding round? Today, not only am I going to explain why it's called a Series A round, but also what it means and how it relates to the generally accepted naming of different stages of startup funding. By the end, you'll understand the difference between funding rounds from pre-seed to Series D when companies tend to raise each and how to navigate each stage successfully. Hi. My name is Peter Harris, and over the last 15 years, I've invested in pre-seed, seed, Series A, B, C, D, E, F, G? Yeah, G. Rounds of over 100 companies. Before I jump into this video, I want to hear what questions you have about any of the stages of startup funding. Pop down to the comments, let me know, and while you're down there, don't forget to like and subscribe to this video and this channel to get more videos like this one. Before we dive into the details, let's understand why startups raise money in the first place. Growing a business requires significant capital, often more than what founders have in their bank accounts or can generate from revenue alone. That's where angels and venture capitalists come in. Think of startup funding like a racing game. Each funding round acts as a checkpoint, giving your startup more time or runway to reach the next stage of development. The stages of funding you will typically see for private companies are pre-seed, seed, Series A, Series B, Series C, etc. After that, a company will either go public, i.e. IPO, or not need any more funding. But why are they called Series A, B, and C? Well, it has more to do with the security that's being sold. See, when a VC invests, they typically want preferred shares. Check out some of my other videos where I've talked about that topic. This is because preferred shares give them some specific downside protection, information rights, control provisions, and other things that help protect their investment while simultaneously maximizing their upside potential. These preferred shares have a name, particularly if it is anticipated that there will be additional classes of preferred shares in the future with different rights and terms. In reality, you can call the shares whatever you want, like Joe's preferred shares. But to help keep things clean and easy to understand, investors typically stick to a general framework of naming the preferred shares based on the development stage of the company. So a Series A investment really refers to the fact that a VC is buying Series A preferred shares in a company that has typically achieved a level of product market fit, for example. Now, let's explore the different stages of startup funding. Pre-seed. The pre-seed funding round is the earliest stage of financing for a startup, typically occurring at the ideation or concept phase. It's so early that it's not always viewed as an official round of funding. Let's take a closer look. The average pre-seed funding amount is roughly $500,000 or less. It's often provided by friends, family, or occasionally from funds that specifically target this stage of company. It is super high risk because rarely is the company anything more than a couple of people and a cool idea. Currently, 90% of startups fail, and it's probably even higher for pre-seed. And the success rate for first-time founders is only 18%. The odds are not great, which means that most of these people, investors, will not get their money back, let alone a return on their investment. This is why some people refer to this funding round as one from friends, family, and fools. But if you're a founder, you're very grateful for those friends, family, and even fools because they help you finalize your prototype, which might have been very expensive to make. They help validate your idea and market, make some product, and maybe get some early customers. The milestone that investors fund here is getting a viable product into the market. Expect to give up 10 to 20% of your company at this stage. Now let's move on to the seed stage funding or angel round, which you can guess typically includes angel investors, though it can also include seed stage venture capital firms or crowdfunding platforms. This round can range from a few $100,000 to a few $1 million. As a founder, how do you know when you're ready for this stage of funding? Well, you could still have no revenue or revenue up to $1 million. You may have a fully functioning product or what we sometimes call a minimum viable product, MVP, and some proof that people actually want your product. This is when they are typically ready for a seed round. This is still an extremely risky round for investors and most will fail. Ron Conway, considered by many to be the godfather of angel investing, proved this point with what many consider to be the first true seed fund. He made around 50 investments, lost money on 49 of them. Fortunately, the 50th was Google, and the rest is history. The money can be used for many purposes, such as to fund product development, build out the team, get more sales, but the biggest and most important milestone from this round of funding is achieving what's called product market fit. There is a big valuation and risk reduction inflection point between companies that achieve credible product market fit and those that don't. Product market fit basically means that the company has found a very large market that needs a product and is willing to pay for it. Generally, investors benchmark this with at least 1 to 2 million in revenue in a minimum $1 billion plus market. Expect to give up 10 to 30% of your company at this stage. To move on to the next stage, Series A, you need to hit around 1 to 4 million in annual revenue. This is when you've achieved product market fit. You have really figured out what your customers want and are solving a real problem for a big market. In this phase, venture capital firms often take the lead. Raising tens of millions for a Series A is increasingly commonplace, with a typical range falling between $5 and $25 million. However, the average amount hovers around 15 to 20. Series A funding comes when you are really ready to scale the business and take it to the next level. This is where it is time to explode and get that hockey stick in revenue growth. That growth will come as you increase your marketing efforts, develop new products, and expand into new markets. The key milestone to achieve from this funding round is building out your marketing and sales machine for scale. Expect to give up somewhere between 15 and 25% of your company at this stage. Moving forward, we have the Series B funding round. At this juncture, your revenue is likely surpassed $5 million. While the average Series B round amounts to $25 million, it's not uncommon for some companies to secure as much as $100 million. However, it's crucial not to base your funding amount solely on comparisons with other startups. Instead, focus on raising the capital your business genuinely requires to get to the next milestone. I can't tell you how many startups I've seen crash and burn because they raised too much at too high of a valuation, and then wasted a lot of money and never could achieve that valuation in subsequent rounds, leading to a total collapse of the company. Don't let that happen to you. Venture capital or private equity firms typically provide this funding. Often they are the same VCs from your Series A stage. With your business showing substantial growth and key performance indicators, KPIs, moving in the right direction, this makes an investment far less risky than the seed round or Series A, so investors are now willing to invest a lot more money at higher valuations. The key milestone here is putting the people and pieces in place to scale aggressively as the company raises larger and larger growth rounds in the future. Plan on giving up somewhere between 10 and 15% of your company. Let's explore Series C rounds. Series C funding is typically led by venture capital firms, growth equity firms, private equity firms, or hedge funds. The average amount raised during a Series C round is around $60 million, but at this point, this number can widely vary depending on the startup's valuation and funding requirements. I've been in Series C rounds that topped $1 billion and smaller ones that barely broke $20 million. So it really just depends on the company and its needs. You know you are ready for a Series C round when you are ready to start scaling aggressively. This might mean that you have started to expand internationally, have multiple revenue streams, and/or are quickly becoming a market leader. You're no longer just fueling growth through generating awareness for your product. You're fueling growth by exploring new revenue channels, potential acquisitions, and you are preparing to eventually do an IPO and start trading on the public markets. The key milestone here is to demonstrate a clear pathway to 100 to 200 million in revenue so that investors believe that you can eventually go public. Plan to give up 10% of your company in this round and really in all subsequent rounds from here on out. Finally, we have the Series D funding round and really beyond. So pick your letter, Series D, E, F, G, H, I, J, K, and so on. Sometimes these rounds can be considered pre-IPO rounds, meaning that this is the last private funding round before a company goes public and can be used to strengthen the balance sheet so that public investors will have confidence investing. It typically happens when the company is mature and aims to achieve specific goals, like entering new markets, producing new products or services, or preparing for an IPO. This funding round is used to support the company's growth and strengthen its position in the market. Institutional investors, such as venture capital firms, growth equity firms, private equity firms, hedge funds, and another firm called crossover funds are usually the ones leading or investing in Series D and beyond funding rounds. The amount raised in Series D and beyond can vary widely, with hundreds of millions to billions of dollars depending on the startup's needs and the growth potential for the company. For example, when I invested in Spotify, they were already doing over $1 billion in revenue, but they achieved $5 billion in revenue when they finally went public and we sold our shares, having raised billions of dollars along the way. The average, however, is closer to probably $50 to $60 million, although in the last few years that's probably edged up closer to $100 million. And it's important to note that not many startups go through a Series D funding round, and many raise many more rounds prior to going public or being acquired. Roughly when you get to the Series D round, there's a lot of potential outcomes, whether you raise a lot more money, you get acquired, or you go public. For many startups, Series C is really the final round of funding. After Series C, companies may either sustain their growth with existing revenue, undergo an exit, or go public via IPO. Only a small percentage of startups proceed to Series D and beyond. All right, now we have learned all about the different rounds of funding for private companies, and you may be overwhelmed and thinking, is there a way to just avoid raising money altogether? Well, the answer is yes, you can. It's called bootstrapping. Bootstrapping refers to the practice of building and growing a company using minimal external resources or funding. Instead of relying on outside investors or loans, bootstrapping entrepreneurs use their own savings, revenue generated by the business, and sometimes resources from friends and family to fund the company's operations and growth. If you'd like to learn more, check out my video here and linked in the description below, where I talk about the pros and cons of bootstrapping your business. And there you have it. An overview of startup funding from pre-seed to Series D and information about bootstrapping if you decide to just avoid investors altogether. If you have any other questions, please comment below. I would love to hear from you. If you have any really good questions, I may just create another video to give you the very best answer. If you found this video helpful, please like and subscribe to my channel for other videos on cap tables, raising money, and understanding the rules associated with different funding options. Thanks for watching and happy fundraising.